Good morning, everyone, and welcome. This is Joe Scarice, Senior Loan Analyst at Lenmar Capital, co-founder of the Creative Birth Strategy podcast, Creative Birth Strategy podcast on Clubhouse. We're here live every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. So we have a great subject today. I'd like to just to discuss it real quick, get it out there, and then we'll thank our sponsors and do a little update to the market. We're going to be discussing raising private capital in 2025. Very excited about this discussion because a lot of people always come to me for direction and suggestions, and I think like as a real estate professional, we need to know a little bit about this and dive into this today. So we're going to break it all down. We'll get it started here in just a few minutes, and we'll get it rocking and rolling. And I'm just pinging some peeps in and getting started here, inviting some people here on Clubhouse. Just give me a few minutes. In the interim, though, I want to thank our sponsors as always. I would like to thank Mr. Yordle Perkins of Perkatech, who provides social media strategy and architecture for real estate professionals nationwide. I'd like to thank Lenmar Capital, where I'm a senior loan analyst, providing nationwide asset-based lending, DSCR, multifamily, mixed use, single family through four family, fixed to rent, fixed to flip, and new construction nationwide. And let me know if you have any questions in regards to that. I'd like to thank MB Capital, where I am a referral partner in the unsecured business line of credit program, providing unsecured business lines for real estate professionals and business professionals throughout the country nationwide. I'd like to thank Miss Linda Pelagas of Realty 411, who provides a national publication and national event uh, for real estate professionals throughout the country. And last but not least, I want to thank Real Estate Mastermind Strategies, where I am now providing networking events now in Delaware, Pennsylvania, New Jersey, Connecticut, New York, sponsoring so many different events in the Northeast region. We're staying very aggressive in providing that educational piece live in person. And last but not least, I'd like to thank two other entities where I have my real estate licenses. In New Jersey, I'd like to thank Realty Solutions, where I have my New Jersey real estate license. And I'd like to thank TCS Property Management, where I have my Pennsylvania real estate licenses, where I provide CE accreditation for real estate agents as well, nationwide with asset-based lending fundamentals workshop. So let's talk about this past week. It's been a wonderful week. I think I met close to 200 people live in person at various events that I sponsored and promoted and provided. It was a lot of fun. We were in South Jersey. We had a great happy hour Monday. Tuesday I was in Delaware County, Pennsylvania, with a bunch of about 50 real estate investors. I think Wednesday I was in Lehigh Valley, where we hosted our own event. And then again, I was in Lehigh Valley for another colleague of mine. We know Garrett Rhodes. He provides a great event second Thursday of every month. And then I ended up in East Stroudsburg, Pennsylvania, for a great Sub Two Owners Club event Friday night. We had about 100 people, networking, strategy, just connecting. But you know what the best part was? I went to an event after an event. I went to a cigar bar not too far away, and it was just a whole huge group of real estate investors in the immediate market, and we were just talking business. And so, I mean, I didn't get home till like midnight from networking on Friday night. It was so much fun. So, what great week ahead coming up. We're going to be in Philadelphia tomorrow night. We're going to be in North Jersey on Tuesday. Wednesday, we're going to be probably back in the Philadelphia market. Thursday, I'll be in Maryland. Friday, we're hosting a rooftop event down in Old City, Philadelphia, for the Sub 2 and Owners Club community. And Friday, I'll be in New York City for a Sub 2 Owners Club community meeting with about 150 people at 110 Fifth Avenue. Anybody in New York, please join me. I'd love to see all of you in Manhattan on Saturday. So let's dive into our subject today. First, we'll talk about some updated on the market. I had a big meeting with our lending group, our underwriting on operations. It looks like rates are going to come down at least almost a full half a point, which I feel is going to impact not the consumer as much as the whole as the investor. I see major opportunity. Um, for the investor coming into the summer months here. I saw a little quote down here on the chat box. Yes, 110 Fifth Avenue. It's the Compass corporate office, Christina. So right now we're seeing home buyer sentiment at a whole all-time high, and I see a investor sentiment at all-time low. I think the investors get it; they see the opportunity. It's going to be a very unique opportunity. DSCR is going to drop almost a full half a point. We feel sometime the next week or two. Rates have been coming around high sixes right now. I think that you're going to see that reflection. A lot of the hedge fund money is dumping more money into the industry. So pretty excited about seeing that. We're probably going to see rates in the sixes. I don't want to say low sixes. I want to say high sixes on DSCR. Probably going into the next week or two. Bridge money, fixed to rent, fixed to flip, and new construction has already dropped. Your base rate right now is around 8.99. So if you're going to get into that light burst strategy opportunity, you're going to get into that fixed to flip. There could be an opportunity there for you, with cheaper money. Obviously, credit and the deal itself and how everything kind of looks would still need to make sense. But I really feel we're really coming around the corner with rates for the investor. Now, for the consumer, like I said, it's going to be a tough way of thought pattern when you have such an aggressive real estate investor group coming out and buying in the DSCR space. But like I said, it's looking good for the investor right now. An article that I'm going to be posting up today. Real estate investors are outpacing home buyers. This is, again, this complements of what we're talking about today, raising private capital, talking about the mortgage industry, rates dropping in favor for the investor, as growing prices and unyielding high financing costs keep many other potential home buyers from purchasing. Real estate investors are grabbing a larger portion of the available homes in the United States. It's very evident, the numbers. If a realtor wants to deny that in their space, knock yourself out, but you're going to be leaving a lot of money on the sidelines, not being real estate investor friendly. Another article that caught my eye as well: renters gain bargaining power as asking rents drop. I've been seeing this for the last 12 to 18 months. I'm seeing the compression of rents because of the influx of so much renovated properties coming to the front line. Also, especially when the flippers had to hold a lot of these properties, so they couldn't flip to the home buyer because the home buyer's not buying right now. So now they had to hold a lot of these properties. So you got better quality home buying like properties for rent, and the market got competitive, especially in Florida. I saw that very heavy. Very interesting article to keep in mind and take a look at. So let's dive into our subject, and then we'll get into our moderators and get some updates on some great things that are coming up through the Great Creative Birth Strategies podcast as well. Why private capital? In 2025, when tightening bank regulations and higher traditional lending standards, private capital is more important than ever for real estate investors seeking flexibility and speed. Private investors want passive income and asset-based opportunities, and real estate remains a favorite choice. Some top strategies to raise private capital in 2025. You need to build a personal investor brand, be visible, establish credibility, host local or virtual events, offer multiple structures, equity deals, debt deals, convertible notes. Target the right capital sources, accredited investors, self-directed IRA holders, family office and small funds, professional networks. Rising investment strategies in 2025, pairing capital with the right real estate play is key. Midterm rentals, 30 to 180 days, build to rent communities, affordable housing conversions, co-living and shared housing, fix to flip, and BRRRR. There's very high cash flow. There's a lot of institutional demand. There's a lot of public-private partnerships out there, high yields, and strong and low inventory markets. What are you offering in the private loan debt space to your investors? 10 to 12% annual return, 6 to 12-month term, first lien secured by property. Is it a syndication, more of an equity play? Look at a 70-30 split after 8% preferred return, quarterly distributions, 3 to 5 year hold with refinance or sale exit. Now, raising private capital requires regulatory awareness using SEC exemptions like 506B, 506C, and Reg D. providing also a private placement memorandum, subscription agreements, and working with the securities attorneys. So these are things that you need to kind of set the tone. And I'm going to give you some additional information because I really think, a top team of real estate experts you need to surround yourself with when raising private capital for real estate. You're definitely going to need your securities attorney. You're going to need to talk with your CPA. They need to talk to one another. A good real estate attorney, private capital raising consultant, or potentially a syndication mentor. A good general contractor or construction consultant. A very good underwriter or analyst. Experienced property managers or asset managers. You might have to look at a capital raising partner or investor relations manager, a good title company or escrow officer that's investor friendly, a good commercial agent. Now, some other optional additions that I would probably keep in mind. I would definitely want you to obtain or identify a good cost seg specialist, a good bookkeeper, a good marketing and branding expert, and a third party fund administrator for large pools or syndications. We got that rolling out there. We got a lot of good content to think about at raising private capital in 2025. Amy, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning, and some updates to Creative Birth Strategies podcast and Clubhouse and everything else. Raising private capital 2025.
Thanks, Joe. Thanks for having me. I've called multiple hats, but I've been a real estate investor since 2008, and I have raised private capital since 2010 for real estate deals. So I've been doing it a long time. So this is a great topic, and I hope I can share a few nuggets of wisdom. But I'm currently the chair of the U.S. PropTech Council, which is the trade association for the real estate technology industry in the United States. And down in the audience is Miss Christina Prestano, and we're starting local chapters around the United States, and my New York hookup is down there. Hey, Christina, nice to see you. So if you are interested in, if you're in the New York area and you're interested in getting involved with the U.S. PropTech Council, reach out to Christina. We also have local chapters starting across the United States, U.S., and so Austin, Dallas, Miami, New York, Boston, Chicago, D.C., Seattle, Bay Area, Los Angeles, any NFL city across the U.S., any large enough city that has a good cohort of real estate and project, we are starting a chapter. Atlanta, I'm trying to think of all the chapters we're locally starting, but even some in Canada and some in Mexico. So yes, so that's what I do today. I'm also a PropTech founder. But for this, and I have an AI company. So I'm trying to think of all the things I do, Joe. Oh, and then right after this show, I'm kicking off a new room in this Birth Strategies Clubhouse. Joe's been gracious enough to let me use his house around real estate and technology, since that's what I do every day. So we're going to be talking about AI for realtors right after this room, starting at 10 o'clock. All right. To the topic. I've been raising capital for real estate since 2010. And I'm currently working on deals today. I will always be a real estate investor. You can't take that away from me. And so I'm working on a deal today, which is a fourplex that I'm buying in Austin, Texas. And it's going to be a long-term flip because we're going to basically doze it and build a 4,000 square foot, $5 million home on it. And it's just, so when you're raising private capital, other than what Joe's kind of told you to do, yes, there's regulations. Yes, you're going to need attorneys. Unless you're doing like a joint venture, you won't need a syndication attorney. Understand the difference between what a JV is and when you are actually raising capital from someone to buy real estate. So the difference is, in a joint venture, they're an active participant in the deal. They have an active role in the deal somehow. You give them a job as a part of the real estate deal, right? And it has to be laid out that way because it's how the IRS treats the income. So that would be an active income scenario, so they can do joint ventures. If you're doing a passive income scenario where they're giving you money, you're investing their money into a real estate deal. That's a passive income scenario. The SEC considers that a security. like any other security. If an investor was going to invest in stocks, or if they're going to invest in mutual funds, whatever, if they're investing in your real estate deal as passive income, they're a limited partner in that deal. That requires all the exemptions from the SEC. It requires you to have a securities attorney. It requires you to have a PPM and operating agreements, and you create LLCs. It is a great way to raise capital, and like I've said, I've done it since 2010. But you typically do it on larger deals where you're raising. It makes sense where you're raising over $1 million or more on doing that deals, because there's expenses associated with doing syndications from a tax perspective, from an ongoing maintenance perspective, and investor relations, and all those things. So if you're starting small, think JVs. You can always put together a joint venture with 2 or more people putting a deal together. A lot of people call that a partnership. Some people call it a joint venture, but just understand the tax treatment for each, and what you're going to have to do if you're the sponsor of the deal and you're putting the deal together, what you're going to kind of need to do. So for instance, on this home that I'm buying in Austin and I'm flipping, I'm doing a joint venture with another group, and they're going to come in as the guarantor on the loan, because I'm a tech founder now. I'm a poor little founder, but I needed someone to make sure that they had enough net worth for the deal, and I have been out of the game for a little while. So people want you to make sure you have experience. And even though I've done all the things I've done in the last 3 years, I've not really invested in a lot of single family homes, actually zero. So you need to make sure you can fill out the bill for a lender, from an experience standpoint, from a net worth standpoint, from all those things. And so you sometimes bring in a partner to carry that load. So that's fine. But those are a couple of things, and then I can talk about this all day long, Joe. You can stop me at some point, but I mean, I can talk about how you have to market yourself, what family offices are. I mean, we could go throughout it. It's great. For
Well,
sure.
Amy, I see.
Sound effects. Clubhouse is getting so much better. Now we have sound effects.
I know. I got to keep up with all these changes on Clubhouse, which I'm so. I listen. They've done a great job in chameleoning themselves out of COVID, and and then staying relevant to this. So I got to thank them, because none of us would know each other, if we didn't have this. So I see this as still a wonderful piece of the pie to the podcast itself. And, you know, during COVID, you had a lot of people online here, you know, trying to sell packages on educating people on something like this, or leveraging them for their own endeavors. I do have a concern as a licensed professional surrounding yourself with the right people when it comes to raising private capital, Amy. So I think there's still that smell and air of Ponzi like, um, people that are out there that will, it's just a one sided environment. I mean, I know some guys and gals local to my market. If you're not bringing 100,000 to the room, you're not really relevant to what they're trying to accomplish, and it's probably not an event you want to go to. Okay. So, from a person that's trying to raise money, I think hanging out with self-directed IRA groups, I think that's a safe haven, because they're not going to allow the bad seeds in the room, or try not to have the bad seeds in the room that are trying to sell packages. And they're really going to try to provide a team of experts to allow you to grow and build out your own concept of raising private capital. Briefly, what's your thoughts on the concern of the selling of the package of raising private capital? Instead of yeah, exactly.
Yeah, good ones and their bad ones. Back in the day, syndicating deals, I was a member of some of those groups, and I know the groups that splintered off from the other groups and created their own groups. And they're teaching you a couple of things. They're teaching you how to do and it's usually around multifamily. Like, I've never seen any of them do it for like industrial or whatever it might be, or small retail strip centers. But I have a good friend that's what he does. He's been doing small retail strip centers, and he kills it. Like I mean, once you learn your space, it's always a good thing, and you'll find people that will, if you learn how to syndicate deals, and that's generally when you're talking self-directed IRAs. Typically, it's a passive income scenario, so you're gonna have to that'll be a part of like a syndication, and you just need to learn the rules, and you get a good trustee, and they use the trustee, and you do everything through that trustee. You don't have to worry about the taxes, you don't have to worry about anything. You just give them their K1s, you give them the distributions, and they take care of it for their person who has the IRA, because it has to be an arm's length away. So somebody who invests their IRA in their deal, they give you money from their IRA for your real estate deal. Typically, it's a passive income scenario, and they have to use a third party because all the money has to go back to their IRA. It can't come to them personally.
Yeah.
So it's a great way for somebody in a self-directed IRA to, increase their pie for their retirement. They just can't take the money that you give them and party with it. It has to go back into the IRA. So you just do everything for people like Quest and other trustees that manage those things on a day-to-day basis. Makes your job as a sponsor super easy, and they do those events, Joe, where they have, they're connecting investors with deals, which is great. And just know the vehicle that you're going to have to create in order for them to invest in it. But yeah, I've lots of my money coming when I was syndicating deals. I would say every syndication I put together, I had at least 4 or 5 investors, and maybe 30% of the deal came from self-directed IRA.
Great stuff. Thank you, Amy. And I think you actually interviewed somebody that actually originally was up here in New Jersey. He's now in Texas, Armand Rachant of MW Law. I think you had him on one of your. He's a really great syndication attorney. I can't remember. I know the company's called MW Law. We had him come out, and he really provided a very ethical and integrous discussion on syndication and raising private capital. And I feel that people that are so transparent about what they're doing and not bullshitting around, not hiding what they're doing, and just being are the ones that are going to be the most successful. You got to be, if you're going to do well with raising private capital, especially in real estate investing, you have to have full transparency. Everything's got to show. And that was a lot of the problems with a lot of the original syndicators and original guys and gals that were raising private capital. They were kind of skirting, like they were just selling the project and not selling who they were. Just sell the brand. If you're gonna raise capital, it's got to be like literally on your chest. I raise capital. You know what I mean?
Yeah, for sure. And thing, if you're an investor looking to get into another sponsor's deals, is you ask them who were their previous investors, and then you go talk to those investors and go, hey, would you invest with them again? And that's the easiest way to know whether a sponsor's worth it or not. Because behind post transaction, like getting through the transaction is like maybe 10% of the deal, even though it feels like it's 1,000,000% of the deal because it's so arduous. But you have to own the thing for 5 years, like at least, right? Depending on what you're doing or what the business plan is. And so the communication back to the investor, all the different things that are happening, and there's lots of times when real estate deals go bad, and I've not escaped. I mean, not every real estate deal I've done has been, a home run. And so, but if you're communicating with your investors, it's always a great thing. But you have to, if you're going to raise private capital, understand you're going to have investors, and you're going to have to communicate to them and know what that strategy is, what those reports look like, what they're going to expect from you. And lots of times when you're raising private capital too, there's a whole systems component to it. There's portals out there now that you use to put your deals in, and all those investors, even the retail ones now, are expecting you to have that. And it's not a cheap endeavor, right? And so having a Syndication Pro or an InvestNext or a Folio Investment Management or some of those portals, everybody has those now, so they're going to expect you to have one. And if you don't, they're going to think, well, you're not legit. And so you just need to kind of know, it's the game of chasing money, and it is what it is. I mean, even on the venture side, the stuff that I'm doing now for my tech company, I'm currently raising capital for my tech company, and that's a whole other different ballgame than real estate. I won't bore you with that, but it's definitely an interesting thing, and it is almost a full-time job for you. So you're going to have two full-time jobs. You're going to be real estate investor, and you're going to be capital raiser, and it just is what it is.
Well, thank you, Amy. Excellent. Bob, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning, Raising Private Capital 2025.
Hey, good morning, Joe. This is Bob Chesick with Chespin Corporation. We help people set up LLCs and corporations. I'm not here to give legal or tax advice. And I think really the best thing to do is kind of review what I was talking about at the event that you had me speaking at. Thank you, by the way, this past week in Bethlehem, Pennsylvania. We talked a bit about the impact of the Corporate Transparency Act and how it spilled over into the lending world. And you had you and the group there had some very excellent questions about it. And really what it came back to was with raising capital and even talking to some of the people on your own team, Joe, basically the biggest thing to remember, especially in 2025, the fallout from the now virtually gutted Corporate Transparency Act is that lenders of all kinds are scrutinizing paperwork more and more, particularly with operating agreements and company status, especially whether or not the company in question is actually registered in the jurisdiction where the properties are being acquired. So some of the things that we talked about was before you're going for the capital, making sure that the operating agreement and the ownership arrangements, particularly on a brand new LLC, are structured properly to get the maximum get the maximum amount of capital, or at the very minimum the desired outcome. Because sometimes it doesn't matter. Sometimes it not only matters who is on the operating agreement as owners, but what percentage of ownership they have based on personal credit, experience, and other variables. The other thing that we were discussing, and this is a big one, and it came up multiple times with people at the group, is not only talking about not only making sure that you're able to produce a letter of good standing, as Joe would call them, or certificate of good standing, as most states would call it, but to also continuously be able to do that. A lot of times I'll see people that set up an LLC and kind of go in the set it and forget it mentality, only to find out that maybe a year or two down the road, when their lenders are doing a due diligence or a status check, they find that the LLC has fallen out of good favor, or worse yet, been revoked or canceled to some extent or to some degree by the state for failure to maintain annual reports or some of the requirements that state has. For example, in the state of Delaware, if you, as an LLC, if you do not file annual reports for 3 years in a row, Delaware will just simply void out your LLC. It's gone. And the restoration cost in state fees alone are going to zero in on the $2,000 mark. And that's just the state fees. That's not counting any fees you're paying to legal counsel, financial counsel, or your registered agent to get all the filings back up to date. And considering that Delaware has a 2 to 3 month backlog, you're probably going to have to spend extra money to expedite these things. I'm actually going through that right now with a client who claimed that they didn't realize they had to file an annual report if they paid income tax, but that's not how this works. Pennsylvania, starting in 2027, will be doing something similar. So the problem being, especially when we talked about New York a lot, because there's some New York attendees there. In New York, if you fail to do the publication and you can't produce a certificate of good standing, it's not like other states where you can take care of it in a couple of days and produce it. In New York, you're looking at possibly a 6 week to 2 month delay, and that might be too long for the lender before they start calling loans. So again, the maintenance, it's not just that you have to maintain the infrastructure that you set up in order to not just raise the capital, but also assure that you don't fall in bad standings, not just with the state, but with your lender, whoever that may be. So those were a lot of the topics that we covered in Bethlehem over that past week. And if you missed it, by the way, I'll be redoing 2 different shows in New Jersey with Joe at the beginning and middle of August. I don't remember the dates offhand. I think the 4th and the 19th, but Joe can confirm that.
Yeah.
So again, nothing I said was legal or tax advice. Joe, I'll throw it back to you.
Hey, I have a sidebar. Oh, go ahead, Amy.
Sorry, Joe. I just wanted to get back to one of the things that Bob said. So the LLC, you said it needs to, and I wanted you to clarify, talking about your LLC being in a state where you're not investing in. You said something about the registration. I mean, maybe that's a Northeast thing, because in Texas, we have lots of folks that have LLCs in Wyoming and they invest in Texas all day long. So I wanted you to clarify that.
In most states, you have to be registered as a foreign LLC in any state in which you're conducting business. Texas may be an exception to that rule. But in Pennsylvania actually was up until very recently. What happens is that essentially if you're conducting business registered in one state, and yes, you can register in Wyoming, Delaware, or any state of your choice, but if you're actually actively conducting business in another state, you have to do what's called a foreign filing or foreign registration. Foreign doesn't mean out of country, it just means out of state. I don't know why they use that term, but it is what it is. The bottom line being, what happens is, if you don't do the foreign registration, you actually can be locked out of filing lawsuits in the court. So let's say, for example, you buy and I say, I'm going to use Pennsylvania as an example because I don't know Texas's rules, but in this regard. But for example, in Pennsylvania, let's say that you bought a property through a Delaware LLC, and now you have a bad tenant, you need to sue to get them out, but you never did the foreign registration. The courts will not let you move forward with that lawsuit because you're not authorized to conduct business in Pennsylvania. Now, up until recently, Pennsylvania did have a rule that allowed foreign LLCs to own property in Pennsildania without registering as a foreign LLC, but that was only so long as you did nothing other than purchase and hold title to the property. If you actually conducted any type of revenue activities within the state, then yes, you had to register. So that's kind of the fine line. Some states will let out-of-state companies purchase property as long as they're not using them for any type of commercial purpose or revenue purpose. But most states do require you to do the foreign filing in order to actively use it for any type of commercial or revenue generating purpose. So I hope that clarifies that, Amy.
Yep, thank you.
Guys, thanks a lot. And one sidebar for Bob. Bob, why do you think, well, I think I know the answer already, but they just raised the level of loan amount in Pennsylvania to a new loan amount that you don't need a prepayment penalty on a commercial loan or a business loan. It used to be 206,400. They raised it over $300,000 now. Do you think that's because of the volume of investor business coming into PA, that the state is recognizing concerns with business lending and non-QM, and how that might impact long-term money, 30-year money? So 30-year money didn't have a prepay below 264.04. Now it's like 305, whatever. What's your thoughts on that with the business lending with the LLC, and do you think that's going to impact and drizzle into other states that have magistratal law like Pennsylvania? You know what I mean?
I think a lot of it has to do actually with Pennsylvania. It more recently trying to become more aggressive with attracting businesses and capital, especially when they got an unexpected population boost, temporary as it may have been in 2020, when a lot of people started evacuating New York City and moving to the Poconos and other areas of eastern Pennsylvania to get away from the COVID restrictions that New York and New Jersey were putting down. Pennsylvania was definitely a lot looser in that regard. And Pennsylvania, the biggest problem Pennsylvania had historically, and I'm going to bring this forward to what you're talking about, is that Pennsylvania for a long time had an identity crisis that back 100 years ago, it was the coal capital, it was manufacturing capital. It was a very, very solid first-class state, but largely in the manufacturing and blue-collar fields. And when that started to fall apart in the 1950s, Pennsylvania kind of just had this identity crisis that they didn't understand that they need to be competitive to keep up with other states, even the bordering states, in order to attract industries and businesses that they wanted. Basically, we can't do it the way our grandparents did it years ago. Well, until recently, a lot of the legislatures and the governors were very, very content to just keep everything the way it was. But more recently, you've had some much, probably starting with the Tom Ridge administration back in the 90s, starting to realize Pennsylvania's got to get with the times in order to become more competitive. So I think a lot of that, and seeing some of the other moves that the state is making as a whole, I think that it's more that Pennsylvania is trying to take advantage of its location and its competitive edge versus. So yes, the ability to raise more capital. That a lot of it is. There's an effort right now to clean up the arcane laws. Joe, you and I have privately talked about PA's bizarre liquor stores, which are a cash cow for the state, and how there was efforts to privatize them. And I think Pennsylvania really is just trying to modernize a lot of their laws, but there's a lot of work they're going to have to do. And by the way, in a similar vein, just to note, there actually is a bill on the table to completely abolish property taxes in Pennsylvania by the year 2030. I doubt it will go anywhere, but to actually see them move in a direction where they're looking at reduction of taxes and abolishment's another thing. And I know this doesn't apply to LLCs, but for C Corps, they eliminated the capital stock and franchise tax entirely, and they're reducing the corporate tax rate, I think, down to 4.99% over the course of the next several years, which for Pennsylvania, which will actually make Pennsylvania among the lowest tax states in the Northeast and the East Coast in general. So I think that the changes with that ultimately are tying into a broader effort that the state is making to make the state more attractive. They've got a lot of ways to go, especially with the mess of local taxation and whatnot, which you and I could run probably 10 rooms on and not get to the bottom of it at all.
Yeah.
But they're taking steps in the right direction overall to get the state to be more fiscally competitive to attract the larger businesses. That's kind of my unsung opinion on it.
Yeah, as a lender, Pennsylvania, I feel, has always been the last to do something in the country. And now I'm finding them doing more things related to real estate investing and real estate as one of the first people to do things. Like the wholesaling license with the real estate agents, I thought was a good move. This moving up the no prepay on 30-year money for asset-based lending, on the business lending space to 319 from 26400. I feel that is something that's going to translate into the asset-based lending space nationwide in some time, not tomorrow, but I think because you got to remember, most commercial lenders, including myself, have a 5-year prepay in a lot of these loans in a lot of these states where people are like, "Oh, I'm stuck in this prepayment on 30-year money. What if the rates change?" Okay, well, that makes sense. Or if I want to sell the property, there's a penalty. But people don't really understand a prepayment penalty, especially when it comes to raising private capital. Bridge money doesn't have a prepayment penalty. 30-year money has a prepayment penalty. The only difference in the prepayment penalty is you just can't pay the debt off entirely. You're allowed to get up to 19% of the loan amount per year the first 5 years without penalty. So if the loan amount is, I don't know, I'm just using 100,000. You just can't pay more than $19,000 a year if that's the balance toward the total balance without paying penalty. Then it's considered a payoff or pay down. So there's workarounds. I don't want to call it. I guess you got to call it a workaround. But there's ways of working around the prepayment if you want to keep keep lowering the balance, and you're coming in with a lot of money to kind of leverage against debt. That might be a way to do that. But I think what Pennsylvania is doing is setting a precedence for the whole business lending platform as a whole in asset-based lending, Bob. And that's where I was going with this.
Gotcha. They definitely have been setting a lot of precedents across the board on a lot of this stuff. On the loans, I mean, I admit that's more your jurisdiction than mine, so I'm not quite as familiar with the details as you would be. But just as an example, and I know that you and I talked about this. We're going all the way back to October 2022, when Pennsylvania unexpectedly shut the corporation's office down for 2 weeks, announcing a systems upgrade. And when they came back online, PA went from having one of the most arcane systems to set up an LLC in the country to the most modern, and they just leapfrogged right ahead of everybody, even doing a system that far exceeds what Delaware even has today, and that was a massive jump. And I think you remember, Joe, how frustrated your customers used to get when they'd call me to set up an LLC and they needed it quickly. And I told them, well, okay, but there's going to be a $400 surcharge, because not only is the state charging $100, I have to send someone to Harrisburg for a day to stand in line and then pick up the paperwork at the end of the day. And then on Halloween 2022, that was totally abolished when they finally allowed expedited transactions online. And I remember you even saying to me, how the hell did you lower your price $300 overnight? So it was such a game changer. And we were an early adopter of the system too, which was great. But Pennsylvania, like I said, it's not just the loan stuff. They're going across the board, really aggressively making plays. And I wouldn't be surprised to see some more innovation come out of them, both in the financial and in the business sectors, as they're trying to build up a bigger business community, particularly in and around some of the smaller cities scattered throughout the state. They've also been very aggressive with the second class cities like Scranton and Allentown, Erie, and whatnot, all over the state.
Good stuff, Bob. Thank you for your insight this morning. Raising, tying in the pros and the cons to raising private capital. You got it, especially relevant for the 2025 lending environment, right? Speed and flexibility, right? Scalability. You have to have creative structuring, like what Amy and Bob were talking about, and JV agreements, preferred returns, profit splits, the right structure of the LLC. Typically with private capital, there's no traditional loan requirements. You're not same thing in the asset-based lending space. You're also trying to build credibility in relationships, strong track record, consistent returns, more investor referrals, potential for long-term capital partnerships. Some of the cons of raising private capital: there's regulatory and legal risk. Got to be very concerned how far you go in discussing, or trying to not touch on violations of SEC regulations. And then the loss of control, bringing outside capital also means giving up equity or decision-making power sometimes. And, investors may want some oversight and voting rights. I mean, I have a situation right now where I'm trying to get an appraisal ordered on a multifamily building in Mississippi. And because the one partnership is a third, they can't get the other 2/3 just to order the appraisal to know whether we could take it bridge or Fannie Freddie. I'm like, listen, we're $2,500 away to find out what we can do. I can't provide you any more insight. Should I kill the deal? That was the question I posed to the team now, because you got too many spoons in the soup that nobody has the right to move forward on something. So the control piece is a concern when raising private capital. And then there's obviously ongoing investor management that you have to have concerns with, higher expectations and pressure. There's a lot of pressure on profitability and cash flow, and getting what's the exit strategy look like in raising private capital, and a delusion of profit sometimes for some of the people that are not proficient. They're just not literate financially. Can be concerned about some of those people. So you gotta, what private capital fits right: fix and flip, new construction, long-term hold. You gotta stay friendly with, the syndication attorneys, and talking to, SEC related team of experts, and going to events that you're surrounding your people with those type of, with that type of discussion on a day-to-day basis. Ed, good morning. Thank you for your patience. Brief overview and thoughts to raising private capital 2025. Ed going once. Ed going twice. Felix, good morning and welcome. Brief overview, who you are, what you do, and thoughts to the discussion, raising private capital 2025. And give us a quick update on what you're doing also with the Sub-2 community and Owners Club coming up in August, I think, as well.
Absolutely. Grand Rising, everybody. Thank you, Joe, as always. Felix Buchanan Sr., Buchanan Enterprises, the JLix Group. Also a team leader of Keller Williams' team. As I mentioned a couple weeks ago, we transferred from Exit to Keller, which is exciting. In reference to the topic, raising capital, I do a lot of raising capital through using business funding, which was something that I learned over the course of 3 to 4 years ago. Getting the credit cards or lines of credit, 0 APR over the course of whatever time. Of course, to be on that platform, you have to have a 700 credit score, 2 credit cards over 2,500, and a utilization rate of less than 30%. The good thing about that is that those credit cards provide a lot of balance transfers, or you can get other cards that continue to allow you to use that capital for 0%. You can do lines of credit as long as you pay give an example, PNC does like a 70,000 initial line of credit if you fit that criteria. However, it allows that if you pay it consistently, that line of credit continues to grow. So if you start at 70,000, let's say you use 25 of it, and you made sure that you paid it back every month consistently, or after whatever flip or deal that you did, you put back the lump sums of money, those lines of credit grow. So I also use private lenders in the sense of raising capital through family members, putting together contracts that I've done as low as $2,500 per person, and then here's the return on investment in which that you get back once the investment moves forward. So those are the main things that I currently do now. Of course, hard money lending, which is not necessarily a level of raising capital to an extent. But those are the main sources in which that I use now as far as raising capital. So that's my knowledge and wisdom on the raising capital side. In reference to the sub-2 community, I did meet with Sheena. It was a great day. We actually were supposed to connect for an hour, and because of things that we could help each other with further, we ended up being together for 6 hours. All of the 3 locations that I showed her, she wants to use all of them for different. Took her to a rooftop location downtown Baltimore, where that's where the lending office is. So she loved that spot. I took her to another spot that's kind of like a health and wellness, but it's open area. So that's the main spot that she wants to use. And then because of me opening up a nail, hair, massage, esthetician, lash spa, she wants to use that as well to do teaching, and then have it like just for females, like a pampering day. So the connection is awesome as always. I greatly appreciate you and everything that you've done since the day I've met you. So that's that.
Felix, I thank you as always. Felix and I go almost back 20 years. So he just keeps getting younger looking, and I get older looking. So that's how it works out. It's okay. We'll just stick to trying to stay ageless.
That's not true, because you definitely don't look your age either.
Well, Felix has. Thank you, Felix. He brought up some great subjects here, and it ties in. Will we see more private capital raising for real estate investors in non-QM lending? Yes. We will most likely see more private capital raised for real estate investors in non-QM lending space, especially through the second half of 2025 and beyond. And why? Continued tightening of traditional credit, growth of investor borrower segment, attractive yields for private capital, securitization and institutional appetite, the rise of white label lending and tech-enabled platforms. Now, I teach white label marketing and lending programs every month now. This was something I didn't do at all 24 months ago. I'm teaching people how to white label. We have another course coming up August 9th in Philadelphia. We have another one in September 21st in Lehigh Valley. I have another one in Lehigh Valley in October. Okay, because the appetite to represent money is become very important for a lot of real estate professionals as an extra or additional revenue stream. The outlook to me, where more syndication of private funds and structured deal vehicles will emerge, is in the DSCR loans from a 1 through 8 unit portfolio or property, bank statement and P&L based loans, foreign national investment lending, bridge to debt service coverage ratio transition models, and new construction and fixed to rent portfolios as well. Stephen, good morning and welcome. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to Rising Private Capital 2025.
Hey, thanks. Yeah, this is Steve Franco. I'm an investor, and I'm starting to get a lot more. I do a little bit of private lending, but on the larger private capital, getting a little bit more into that as I get more into self-storage. One of the things that I found, and as both a potential syndicator putting together self-storage deals or someone investing in deals is the number of ways that the syndicators explain their returns. And if you're not savvy in it or comfortable in it or understand what they mean, it can get very confusing. They come off, and we've all seen the ads, 45% return or 100% depreciation. That comes from some of the oil guys. Sometimes they talk about IRR, ARR, different acronyms, and they talk about preferred, and they talk about overall. Maybe they say 8% preferred, 2.5x over the life of the money, and that is probably all correct. Honestly, some of it I kind of don't follow because I don't go deep enough into the deals. But the most important thing is whether you're investing in it or you're collecting the money and you're organizing the thing, is to be able to clearly explain and understand what it is. I was working on a self-storage deal where the seller was going to get involved as a partner, kind of a seller finance, but not really scenario, actually coming in as if their land was an investment. And, what I threw out as a plan of how the money would work and how the repayment and profits and whatever, the attorney, who's very experienced, looked at me, he's like, you mean this? And we went back and forth because we just weren't on the same understanding of the terminology. So that, I think, whether you're putting your money into something or whether you're creating something for people to put money into, and definitely if you are in the space where you need a PPM or whatever, definitely get that. But you always need to get advice on whether what you're suggesting is legal. And you also always need to be able to explain either what you're suggesting the investor get, and if you're the investor, you need to understand that, because there's so many different terms and acronyms and platforms and ways of doing it, preferred and everything else, that is very quick, at least for me, it gets very quick to get confused as to, well, is this one better than that one? How should we do it? So, being clear and understanding, I guess, is kind of what I encourage everyone to be very careful with.
Well, thank you, Steve. Good to see you again this morning. Always a pleasure. Got to get you to come out to some of the Lehigh Valley events coming up.
Yeah, I definitely want to come down in the next. I definitely want to come down to some of the next ones. And once I get some of the tech stuff I'm working on put together, I'll send it down. And maybe there'll be some synergy there. Thanks so much, friend.
Thanks, Steve. Why is investing into private capital raising in real estate investing has become more appealing? Because in recent years, due to powerful mix of market forces and returns and flexibility, there's some strategies behind attracting more capital like this. The risk-adjusted returns, private capital lending, they can get 8 to 12%, and they don't even have to get dirty. They don't have to have direct involvement. They can make that return. There's even sometimes people will pay higher points in that situation. And it's typically, secured in first position as with a tangible asset. The credit markets, is more favorable now towards self-employed borrowers and real estate investors and foreign nationals and developers. I see the banks and credit unions still there, but I see the asset-based lending getting so creative with private capital, with just creativity and strategy, which the banks will be there. They're not going anywhere, but there's going to be a very big piece of the pie that asset-based lending is going to take in because of the creativity to raising private capital. And it's also hedging against inflation and income generation for a lot of people. There's some people out there that have $1 million in their self-directed IRA. They don't have time to go identify a real estate asset, but they have time to make 8 to 12% and on an asset they can go buy and drive by and touch. Those are the kind of people you want to talk to. You want to have dinners with them, masterminds. I just sat down and spoke with somebody about putting together a real estate mastermind at a beautiful Italian restaurant up in Easton and invite only 20 people, the right 20 people. Because the right 20 people, you could take over a country. Okay, so from a raising private capital perspective, you invite the right 20 people, they know another 20 people. So you don't need a lot of people, you need the right people at these type of events. They don't have to be big, they got to be smart and calculated. That's how you raise private capital, right? You identify that 3 to 4 people and really sit down and get transparent with them. with your objectives and what their returns could be. I'm having a conversation with a close colleague of mine. I've known him for 20 plus years. He's coming in, he's getting money back from an investment. He wants to allocate it correctly. He knows what kind of return. I'm going to sit down with him and work it through to make sure he feels comfortable with everything. I don't want him jumping into something where he's all pissed off at himself 6 months later. Some final thoughts, Bob, in regards to raising private capital.
I think everyone today on stage just gave a lot of very excellent information. And again, thank you, Joe, for having me present in Bethlehem, and again coming up soon in Haddonfield and Jersey City. So just my final thoughts, as you heard, is really you've got to get, at the end of the day, you've got to get your ducks in a row. And if they're all running around and quacking and a couple of them are meowing, well, they're not in a row. So the best thing is as I always say, dot the I's, cross the T's, and make sure that when you're walking in to do that deal, that you have everything laid out, ready to go with all the correct variables. And one more thing I thought of that Joe and I were talking about, if you are going for lending and you're going to set up a new LLC, have the discussion about what the ownership percentages need to look like based on credit before you sign and execute the operating agreement, before you even set up the LLC. It's going to make the process so much smoother for you, because otherwise you're going to have to go back and change things later. And depending on how much time passes, by changing ownership percentages, you could trigger, especially if you've already set up bank accounts and other things, you may actually trigger a capital event, a capital tax event, or even beg your pardon, I had the hiccups there, or needing to reclassify the LLC from a sole proprietorship to partnership, or vice versa with the IRS, again creating a taxable event. So you want to try to avoid all that and get everything lined up in the beginning, ready to go. Those are my final thoughts. Nothing was intended as legal or tax advice. Joe, back to you.
Thank you, Bob. As always, Amy, your final thoughts to raising private capital 2025.
Yeah, I was, by the way, when Stephen was talking, I was giggling because I just like, it's on your journey, buddy. As you raise more capital, you'll learn all the acronyms and different things. But his point is spot on, because depending on who you're raising from, you need to know how they speak. And so if they're talking about equity multiples or cash on cash return, or what the IRR is, and IRR in real estate land is very different than other finance lands. So you need to understand what IRR is to a real estate investor, and understanding that depending on who you're chasing capital from, they speak different languages, especially as you do bigger and bigger deals. I mean, when I was raising funds from institutions, like when I was doing all that kind of stuff, they talk a different language, and just how you present yourself. It goes back to know your audience. If who you're raising from, make sure you know how they speak and what they understand, and even from the attorneys to everyone. So yeah, that was great. It was a great point, Stephen. So there you go.
Amy, thank you, and look forward to hearing about your upcoming podcast here on the Creative Birth Strategies podcast.
Yeah, actually, today. I thought I'd kick it up today. So right after this one, we are having a room on state technology. So y'all stick around.
And one lasting thoughts to what Amy and Bob was saying. Chasing private capital means identifying and targeting individuals or groups of capital to deploy outside traditional institutional channels, and convincing them that your real estate investment or your lending strategy is a smart, secure, profitable place to park your money. Go out, identify high net worth individuals, self-directed IRA investors, family offices, maybe real estate agents and brokers, real estate investors with idle capital, business owners with cash-heavy entrepreneurs, accredited investors in angel or VC networks. Where to find these people? You got to hang out at country clubs, investor meetups, masterminds, cigar bars. I mean, I was at a cigar event, like I said, cigar bar Friday night. There was more money in that room. You could smell it. Wealth managers, CPAs, attorneys, LinkedIn, warm intros and value content, SDIR custodians like Equity Trust, New Direction, and Quest, private capital networks, family office club, or Tiger 21. These are ways to identify opportunities. I want to thank everybody for their engagement this morning and great insight. Listen, if you're not having a one-on-one with one of the moderators, you are missing out on an opportunity in collaborating. There is some major collaboration with the moderators you had today. I want to thank our sponsors, as always, Lenmark. I'd like to thank MB Capital, really 411. I'd like to thank Perkatech, where Yardell Perkins, who's our backbone to our podcast and our social media and our analytics. We're hitting 3,000 to 4,000 views a week on our podcast. I mean, we're very aggressive right now. It's very exciting, and I did post an article on this subject today on LinkedIn, on Facebook, on Instagram, on Twitter, on Blue Sky. If you're not following myself or any of the moderators on LinkedIn, you're missing out on great value add. We're here every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. We have subject matter now booked to the end of November, every Sunday. My quote this morning: one small crack does not mean that you are broken. It means that you were put to the test and you didn't fall apart. Linda Poindexter. Everybody have a blessed Sunday morning. Look forward to Amy's event on the next hour of Clubhouse and the Creative Birth Strategy Podcast home and in house. And everybody have a great Sunday and a great week. I'll be ending the room in the next 30 seconds. And thank you.